And we are live. Welcome to another episode of Unscripted. And I have the great pleasure to introduce Pramod Gosavi. Thanks very much for joining me for the second time. How are you?
Doing good. How are you?
Good, good. So we covered quite a few topics in the first episode, discussing your background, your philosophy around social media, your kind of beliefs around business advancement, career advancement, and so on. With your permission, I'd love to, in this session, dive into kind of the nuts and bolts of venture capital, and specifically how it relates to software and particularly cybersecurity, with your permission. Why don't we get started? How long you been doing this venture capitalism thing?
Yeah, so it's almost, I would say, about 9, 10 years now. So I joined VMware in 2014. So I was the first hire on their corporate venture team. Prior to that, I was at Seagate for a couple of years. That's where I started dabbling. So this was 2012, 2013. But 2014 is when I started doing this as a full-time role. So almost 10 years now.
And for those who are not familiar, because not everybody who watches the show is fully familiar with the term, in a nutshell, if somebody meets you up today and in the elevator and say, "Hey, Pramod, what it is that you do?" What
So
can you tell them?
yeah, so there are three parts to the job. One is obviously the main role is to invest money on behalf of our limited partners. So our limited partners invest in us and they expect us to invest in great companies that can give them good returns. So like number one is basically finding those companies. So I have to go and talk to a lot of founders. So that's like a number one thing, like deal sourcing and talking to founders. So that's the top of the funnel. The middle of the funnel is diligencing those companies. And while you're diligencing those companies, if you're at a growth stage, it's pretty standard. You can look at spreadsheets and CAC and LTV. But where I spend time on the early stages, it's mostly very new. A lot of times you talk to these founders, like only this founder is talking about something very new and you don't even know something is real. So what I need to do is to make sense out of it. And to make sense out of it, I have to do a lot of reading, talking to customers, talking to peers. So that's like the middle of the funnel, which is diligencing the deals and winning those deals and convincing them that I'm the right partner for them on this journey. And the the third part, which is one of the most important part, is after you partner with those companies and most of the times, like most people think that, hey, it's just a investment. Once you make an investment, you let sort of the team run it. And we do that also, but we are not passive partners. So we partnered with the founders pretty closely, helping them recruit, help them find customers, help them shape the narrative, messaging. Like just yesterday, I met one of the candidates for one of my companies. I spent about an hour trying to figure out if this is the right fit for the company at this time.
And if you can pinpoint, you said it's three parts to the kind of the funnel. What do you spend your most time on?
I would say we still have to spend the most time on sourcing because it's whatever means you made investments, but you're always looking for the next new investment. So that takes probably, I would say, a little bit more than 50% of the time. The diligencing is just part of the process as I'm talking to founders and customers. I think that takes it. And then the rest of the time, it's helping the portfolio companies.
It's interesting. And is there a school for that? Like, how does one become a venture capitalist? Because I haven't seen any training, formal training. It seems like almost out of necessity, you were thrown into a role where you were responsible for finding. It's almost like recruitment, right? You have to have like
Yeah.
this background, and all of a sudden you're thrown into recruitment because you have the background, you know what you're looking for. In this particular case, you were a technologist by heart, by formal education, right? And then you also were a technologist by heart because you've joined companies that were growing, and so you've seen that firsthand. And then you became a VC because you were thrown into the gauntlet in terms of making these decisions. So tell me, in terms of attributes, what would you think that it makes a successful VC? What attributes, qualities that a VC needs to possess to make the right choice?
Yeah, so I think there are two main qualities I would say. One is, I think this is a very people-heavy job. If you want to be very successful, you have to be a bit of a people's person. You have to be able to talk to newer and newer people. So the founders come from different backgrounds, so you should be able to connect with them and figure out if they are the right founders. You're talking to all sorts of people, like you're talking to founders, you're talking to potential recruits, you're talking to customers, you're talking to other investors, and very quickly you have to be very savvy, figure out where you want to spend your time, where you want to, which one you want to spend more time with. So I think the best investors, they are very people savvy, like they're very efficient with their time, they spend time with the right people, and they so that I would say like the number one thing. And the number two is something that it's not very obvious. So the number one is very obvious, it's just a people heavy job. The second one that is not obvious is curiosity. So you have to be very curious and you have to learn also. So a lot of people who come from a particular background, they like right now it's machine learning or like cloud. They say, okay, I know machine learning, I know cloud. Can I be a good venture capitalist? And I keep saying that, hey, look, machine learning is hot right now, but 2 years from now, it will be something else. It will be like blockchain or quantum or VR, AR. And you need to be able to judge a company that comes across your desk. And for that, you need to learn. So you need to learn every new technology. You need to be curious. You need to actually pay attention to what the founders are saying, because the founders are coming and educating you, telling you something that you don't know. So being able to listen, be curious, and observe all of that information is very important.
I would say that curiosity is actually the key for a lot of successful jobs and careers, to be able to expand yourself, the skill set. I think any profession that's worth its salt needs to continuously have an investment to learn more and become more proficient and figure out because nothing is stagnant. So whatever knowledge you have would grow mold very quickly. So let me ask you this: why do you even have to build a funnel? You'd think that, okay, well, you're the guy or gal with the bags, you have the money, and you'd think that people would flock in trying to get you to invest. But you make it seem, or at least that what you're saying is that you have to constantly build a funnel of potential investments. Isn't it so hard to find, or why is it so challenging? You'd think that a lot of people would just come over and ask you for money.
Yeah. So that's the hardest part. So, the hardest part is actually like parting with your money. Although people think it's the most easiest thing. So everyone comes and asks you for money, and the question is, do I fund every company that comes through the door? Yes and no. If you're a large fund like Sequoia and others, you get a lot of good high quality deals coming through your door, and you don't need to go and hunt for deals. But what tends to happen is like the good entrepreneurs, they are focused on their business, they want capital, and a lot of times they just don't care where the money comes from. They're not thinking that, hey, I should raise from Sequoia or I should raise from A16Z. They want the money, they want to just move on. So a lot of those founders, you have to hunt them, right? And a lot of times those founders don't even have access to you. They cannot reach out to you. So you need to build that access to those founders by talking to operators or talking to other sort of investors, early stage investors, right? So the good investors, you have to constantly grow your network, because every year, like every 6 months, the founders are coming from different areas, and you need to grow your tentacles. If you just sit in the office and hope for these guys to come in, you'll still get very high quality deals if you're in a large firm, because people come for the brand and they come because you have a big fund. But it's not clear that you're seeing everything, right? And for an investor, being able to see everything is very important.
If I can compare what you do, I would say, especially at this kind of the seed stage or even angel stage, you're looking at penny stocks, and you hope that there's going to be a multiplier. So you're looking at which penny stock should I invest, and sometimes these penny stocks don't necessarily have the correct information attached to them, so it's hard to uncover what the real business is and what the real opportunity is. And my understanding of the VC, and correct me if I'm wrong, is that you invest in multiple companies, and then one or two would succeed and become home runs. They will pay for all the other investment that did not succeed, plus. So that's the business model, which sounds very risky to me, because why don't I invest in something more secure, and you can probably get a return from investing in the stock market and get maybe 6 or 7%. I don't know what in the past several years. So this is not for the faint of heart. Talk to me about the model of how do you become successful, and what is the criteria that you're looking back after doing it for 2-3 years? Because it's one thing to invest, and sorry for the lengthy question. You invest. You can also be lucky with penny stocks. You can put all your money in a penny stock and in a very high risk position, and then you get lucky, right? You get lucky, it turns into a $2 stock, but it doesn't necessarily mean that you can replicate that over time. And necessarily, do you mean that you were a good picker of those stocks? So if you can relate to that, maybe you can expand on that. That'd be great.
Yeah. So just to answer your question, I think on the one or two winners, right? So venture capital is more of a hits business, right? So if you're investing for a 2x, 3x return, that's not worth it. As you mentioned, you can invest in stock market and get much better gains for the risk and the liquidity basis. So venture capital is getting that 100x return, investing at say 100 million valuation and getting that 5 billion or 10 billion like an IPO. And that's what like drives venture capital. It's a hits business, and also that's how the incentives, the 20% carry is based. So you have to get massive returns. So to answer your question, that's how the investments turn out. If you invest in 20-25 companies in a particular fund, you'll have 2 or 3 winners. But the thing is, a lot of times you don't know whether those are the winners. They are the winners, like you can see some potential in those winners, but you're still not always sure that they're going to be winners, right? So this is like a common term in the venture capital industry. Is like every single investment that you do, you think of whether it's going to be a fund return, or like is this going to be like a huge unicorn? So you have that criteria for each and every single investment. Like you never do an investment saying that, hey, I'm making an investment at 100 million valuation. I think this can exit at 200, 300. That's not worth it, because if that's the best case, the average case is going to be much smaller than that. But I think to counter your point about penny stocks in public markets, so things have changed quite a bit now. So previously, about 10 years ago, the companies would go public when they're close to being like a unicorn valuation. They would raise like a very small amount of capital. And then if you're a public investor, you could still ride the wave. Like, so a lot of the big winners like Amazon and others, you could invest in public market and still make like a multi-bagger, like a 10x, 20x with good liquidity. But what has changed in the last 5 to 10 years is the companies are staying private longer, and also a lot of the gains are being made in the private market. So, for example, Databricks, right, is still private. It's at like a 70 billion valuation. So that 70 billion run happened in the private market and not other. Everybody didn't have like access to that, right? So now, if it goes public, if you want like a 10x return, can it go from $70 billion to $700 billion? I don't think so. So if you're an investor that is looking for a 10x return, you cannot operate in the public market. You still see things like Nvidia and others sort of make that run like because of hype, like with AI and everything. But if you want like a very guaranteed return, like I just don't think you can get a 10x return in the public market. And in a private market, that's where it starts. So every single investment, we look at it. It's a minimum sort of 10x. Can we get a 10x? If we invest in 100 million, can it become a unicorn? Or if we invest in like at 50 million, can it become like a 500 million? So it's all about hits. VCs do a good job of assessing if this is the right company, but a lot of things are not in your hand. Like the markets still have to respond to it. The teams have to execute. And that's the variability of this business. So just to recap it. So in a fund, when you make 25 investments, you make every investment thinking that this is going to be a 10x, 100x. You do your diligence and everything. And even after that, you only get a few winners. And that's because the markets still have to respond. The teams have to execute, which is not in your hand.
Yeah, and it is so interesting that you describe it that every potential investment has been evaluated as a fund return. And that's a very high bar, meaning that you're not investing just to double your money because that's not sustainable. You're investing at, at least 100x. And that's a very high bar. I think that's what people don't realize and entrepreneurs don't realize, like at what criteria you're looking at their business. So if you only think, and they can make a good living just doubling or tripling their value. If you invest $2 million and you get $4 million back or $2 million profit, it's a good living for one or two entrepreneurs, but it's not what you're after. And that's where I think that the difficulty lies, that you're looking at those fund returns almost at every single point in your evaluation.
Yep.
And then the other piece is that you mentioned that those unicorns, right? Do you think that the people that made investments in Amazon or Netflix, or you can name a few that went completely out of the park, do you think the VCs look back and say, yeah, I knew this was the case, or I could sense it, or where exactly is the uncompetitive advantage that VCs have to hit home runs more than they lose?
So I would say like the competitive advantage is really the founders, right? So the founders are the key. You're investing in this one or two founders when the company started, and then the whole company basically start and grow from there, right? So that is the differentiated uncompetitive advantage that VCs have. A lot of times, like some of these founders, they're really unique, right? But there's also a risk that they're like too unique, or they're taking too much risk, or they're not operating properly, right? So I would say, if you're a VC, I think you a bit like where this is going, like what kind of founder this is, what the market is. But having said that, you still need some luck. Luck as in it can be like a pure luck, or when a pure luck, you see this companies sometimes they pivot, right? They're not doing well, they pivot into something like Slack was a video game company, and then it pivoted to a collaboration company, and he almost shut that previous company down, and then this company became like a $25 billion company, right? So that is a little bit of a sort of a pure luck, where you actually did not make an investment in a Slack that exists today. You made it in the video game company, right? And the other part of luck is, I think, the market movements, right? Like in 21, 22, the market just went through the roof. The multiples were very high. So if you had late stage investments, you have investments that went out public. You need those market, what we call as imperfections, to make good returns. If the markets are just very rational, you're not going to make huge outsized returns.
Pramod, I love that. I love the humble response, because you're saying, okay, you also need a bit of luck, but you are positioning yourself to get lucky.
Yeah.
That's the key, right? You have to be in the game, you have to make the investment, and then if all the stars align, some which are out of your control, then you hit it out of the ballpark. And I love this answer. And let me ask you a bit about the process. So a lot of times you see a lot of these pitches on a day-to-day basis. You mentioned last time that very quickly, within the first couple of minutes, and a lot of times it's not something they've said, it's maybe their background, or you mentioned also that you go through at great lengths to understand who they are and do your homework prior to meetings to make it more effective. It's something you do. Talk to me about, let's say you're an early stage founder and somebody who wants to work with you. How can you position yourself? Because it's not something that happens overnight, meaning it's not like you're going to meet with Pramod and you're going to get investment because you've done 2 correct things the week before. It's an outcome of a journey that maybe took them a year, 2 years, 3 years, who knows, right? Did they get to that point where they're pitching you? And it's very stressful, right? Because they have like maybe 25 minutes to resonate with you. So talk to me about, the question is really your ideal company, right? What stages, what steps do they need to take over that long period of time to become more attractive to a VC like yourself?
I think it comes down to different VCs having different criteria. So our firm, like myself, has different criteria compared to some other VC. So at an early stage, a lot of VCs, they heavily bias it towards founders. They think that if it's the right founders, they'll eventually find a way out. So for me, it's both sort of founders as well as markets, because if it's a good founder in the bad market, it's still not going to work. So
Pramod, it's almost like buying a house, not to cut you off, but it's like buying the worst house in the best neighborhood kind of thing.
Exactly.
For the real estate.
Yeah. So we spend a lot of time on the market. And this is the kind of conversation I have with the founders, is just, hey, is this a big market? Can you garner like a pretty good price? Can you actually run a go-to-market at scale? Can you charge like 100K, 200K? Or is this like a self-serve? Is this like strategic? Will you grow? Will you be attractive to other platform players? So most of my time is spent like around that on the market first. And then if it's the right founder to go attack those markets, right? So to me, I think it's more about the market, and a lot of times it's also founders. Like even if it's the right market, if I think that the founder doesn't have the right approach, like he's just being too conservative or too aggressive, doesn't have a balanced team, and will still pass. But I would say more or less it's a combination of a market and the founder.
And do you ever keep in touch with potential investments that haven't maybe fulfilled the criteria today because of whatever myriad of issues, but you know there's a potential maybe in 6 months or 3 months or whatever, for whatever reason? And how do you manage to, because if you talk about funnel, maybe you get a bunch of maybes, like you need to continuously monitor the market, also what they're doing and whatever, but how do you do that? How do you operate?
Yeah, I think I was just discussing this with one of my co-investors. I think that is that's the hardest part of the job. So you see a lot of these investments, like we both were looking at this company like 2 years ago. He was doing something, and we both, even the founder, came to an agreement that this is a pretty hard market to crack, doesn't have the any advantage. But that is it. We just stopped talking at that time, and he said he just still wants to do what he's doing. And then he pivoted basically. And then he pivoted. He went to like different investor. The investor just ended up investing in the new thesis. And then we are just like, oh, we knew this guy so well. We had a good rapport. We told him like, hey, this stuff, if you are to think of doing something else, you can come back to us. But that is a challenge with this business is a lot of times you are evaluating these companies at a snapshot at a period of time, and that conversation might not be might not go well. So no founder likes to say that, hey, I'm passing on this company because of so and so, because they feel very proud, they feel very convinced that this is the right thing. So a lot of times they don't come back to the same investor. But I think to answer your point, I do keep in touch. I do quarterly checkups with the companies, but I think a lot of times those checkups are for the spaces that I'm interested in, but it's just that the company is not ready, or I'm giving some feedback to the founder and the founder is working on it. But things where the founder has pivoted, like he was doing something X and now he's doing something Y, which is more or less like a hard pivot, those are very difficult actually. And a lot of times we end up actually losing deals because we just don't know, should we stay in touch? And also for the founders, they don't know if we will go back and invest, because for the founder it's just oh, I'm pivoting right now. What does this founder think of me? Does the founder think less of me? So I might as well go to a new investor where I don't have any history, and a lot of times they end up going to new investor. So that's a bit of a hard part of the job, because you've spent all this time building relationship with the founder, you like the founder and everything, but then you don't get an opportunity to invest when you actually like the thesis.
So, Pramod, they say that two people buy for two reasons. One is to get closer to pleasure, but the other one is to get away from pain. And I think in the VC world, it's the other is okay, making money, but then losing money. So, what is worse, losing money or having that FOMO of fear of missing out, where you lost on investment because of whatever reason, and then it went boom, so you weren't on board? What's worse?
Yeah, so it's always the FOMO, because I think the rule of venture capital is when you lose the money, you lose like 1x, right? So you're going to just lose that investment that you made. But when you miss out, you might miss out on a 10x or a 100x, right? So that's why I think this industry runs on FOMO, is because it's always, hey, if I miss this deal, I might lose like a potential 100x. But if it doesn't work out, that's fine. I might lose 1x, but I'm going to make a bunch of other investments. So it might work out for me.
So you're spilling the beans on the industry, Pramod, basically. So can someone leverage that? Because now I know what makes VCs tick is that ability to convince them that they're going to miss out if they're not going to invest with you. I think we had this discussion before that can you create that or artificially create that? Or I know that a lot of founders are trying to do that and they're saying, okay, no, I have this VC firm already interested. I have these customers. And so they always convey this picture where potentially if you're not investing right now, you're missing out. But can somebody realistically generate that artificially if they don't have it?
Yeah, they do that. So yes, so some of the good founders, not good, I would say these are like good, what they call as a fundraiser. Some people just do a very good job at fundraising. So they do some of that. And we also advise our companies how to run the whole fundraising process, right? So it's a process, and it's again developing a FOMO where you get a couple of term sheets, you get some big firms to look at it, and suddenly the FOMO sort of develops. It's a matter of both timing and also getting the right term sheet at the right firms, right? So if you have a term sheet from another sort of a tier 2 firm, like you have 2 or 3 term sheets, then somebody at a tier 1 firm like starts looking at it seriously. Hey, like this guy has 3, 4 term sheet, there must be something there. And if Sequoia is looking at it, and then if you go to A16Z or Index, they're like, okay, Sequoia is spent 2 weeks with this guy. They had partner dinners and everything. There must be something good, right? So I think there's nothing wrong with this kind of a FOMO because these are all like signals that there's something in the company.
And it's also interesting that you mentioned the skill set of raising funds, a good fundraiser. A lot of time it does not necessarily align with being a good founder or a good technologist. The skill set that you acquire to go out there and sell yourself and raise funds are not necessarily aligned. A lot of times you can be a magnificent engineer and with like amazing abilities to write code and go to market and generate something that people want, but then you lack the ability to sell yourself and sell your ideas and go out and raise funds. How do you balance that? And what would you recommend to somebody who's not, first of all, hasn't had the skill set or haven't had the chance to do it? Because also it's experience. If you're a second time or third time founder, you already raised, you have ability to do it better this time. What do you recommend for somebody who hasn't done this before and is a technologist by heart and wants to learn how to go ahead and raise funds?
Yeah, so I think it's I think it comes down to disciplining yourself, right? So I tell my founders, like a lot of these VCs are just sending you emails saying, hey, let's meet, let's chat and everything. But every single meeting that you do with VCs, they are basically evaluating you, right? So you need to go to the right VC at the right time. So a lot of times, if you're a first-time founder, you get an email from Sequoia and you just think that, oh, Sequoia is going to invest in my company, right? And so you jump in and you think that, hey, I should take a meeting. But guess what? It might not be the right time, or even if you take a meeting, how you run the meeting is very important. If you're not ready for fundraising, how you talk about it, what you disclose, it's very important. And a lot of founders actually struggle with it because either they will not say anything, which is also a bad signal, or they will say everything, which is also a bad signal. Like, you need to focus on something different in those like early conversations. And then when you really have the right conversation, like when you're raising, you need to have that depth, right? So when you're really raising, the more depth you have, the more homework that you do, the more credibility you're going to have and people are going to give. So it's sort of balancing where you're in the process, like how much depth and how much detail the investor want, and managing that process with the people and also yourself.
So you recommend not winging it, basically not coming over and meeting with his VCs without doing your homework. But it's also, and discipline is hard to do, Pramod. If you're a founder and a big VC firm with a brand name reaches out to you, probably 1 out of 10 would say no if they feel that they're not ready. I would say the 9 other ones would say, yeah, of course, I would love that. Who would say no to that? So that discipline is, yes, it's a key point you mentioned, because again, you don't want to open up the kimono not enough, or if it's not the right timing, you may blow up your opportunity to meet them down the road. But it's easier said than done, especially if you're a enthusiastic founder, right? I would say.
Yeah, it's quite, yeah, go ahead.
No, go ahead. Sorry.
No, complete, yeah. Thought, yeah.
Oh, no, I was done. I was just basically just making a statement. It's easier said than done. And it's a very valuable point that you just raised, that allows somebody to have that discipline and to know when you're ready and who to meet at the right time, and to have the right investment and I say investment because it's pun intended, but the right investment from your own side. Be prepared and make the right amount of preparation and to be able to pitch that VC at the right time.
Yeah, that's why I think the second time, third time founders, they do really well because they understand, like a lot of times you see them not raising right away. They'll spend some time thinking about it. They will do some homework. They'll talk to some customers. So all of those, some of those things you learn by your own mistakes. And a lot of times, like people like me, like VCs who have gone through this, we give the same advice to founders. A lot of times they just don't get it because some of these things you just need to learn from your own mistake and successes. Yeah, it's very difficult. It comes down to really trusting your VC and talking through it. Hey, if you're telling me not to take this meeting, why are you saying that? Or how should I approach this? Is this the right partner to talk to? I think it finally comes down to just learning. I think the best founders I've seen, the first time founders who are very successful, they triangulate a lot. They get a lot of information from every party, like they don't discount anything. So they'll get the information from their VCs, they'll get information from other founders, and they triangulate like what's the right thing to do. But again, for a lot of first-time founders, it's very difficult and it's not very efficient to get a lot of these viewpoints and then figure out what works best for you.
Yeah, and it's super interesting because you mentioned that the odds of being a second-time founder are better from fundraising and so on. And I'm assuming that there's some also level of confidence that were successful the first time around. You as an investor have now more confidence in them. And let me ask you this, kind of switching topics to the marketplace, and I want to cover some of these topics. How do you, you mentioned the trends like in cyber, for example, now we have this AI explosion. So I heard somebody say, all you have to do is get AI injected into your deck and your ability to raise funds is like now exponentially higher because now you have the AI into your program. How do you as a VC distill that and make sure that you're not, again, one side is not FOMOing and then the other side is making sure that you're investing in something that's real and it's not going to evaporate within the next 12 months?
Yeah, I think, so we look at whether this is like AI first or is this just like AI washing, or sometimes it's just not even AI there, right? I think the hardest part is when you're just AI washing where, hey, you're using this AI in this like a small piece, but it's really not a big advantage. So for example, like a lot of this like consumer businesses, they tend to be very operational heavy, right? If you have AI like somewhere in your website or in your customer service, it still doesn't make your business like really easy, right? So those are the pitfalls that the founders need to look at, is like how influential and how much leverage I'm getting from this AI. Is this like an AI first deal, or I'm just using AI as a part of the stack? The worst part is really founders, sometimes we are seeing that a lot, is they're doing something very different last year and that is not working. And I keep telling them that, hey, it's not working, just shut it down. Don't try to move to AI, but hold on to what you have. That's the worst thing because you're bringing a lot of baggage. And the first question I asked to this guy is, okay, let's just forget what you're doing last year. If you were doing this year with a clean cap table, like from a clean sheet of paper, what would you do? And I encourage them to think that way and then bring in whatever they can learn or whatever assets from their previous products selectively, but don't just put this on top of that. And I'm seeing that with a lot of founders, they're trying to hold on to everything, plus they have an AI messaging, and frankly, that is not working.
And our founders are reluctant sometimes to showcase what they do. I feel like sometimes people think, okay, if I tell you my idea and how I'm doing it, you're going to go out there and steal it. So what's your take on that? Because I have my own opinion, but go ahead.
Yes, I think there is a fear like that. But frankly, I don't know, it doesn't help both the parties. Like if you don't tell me exactly what it is and if you're cagey, I think that becomes more like a deal breaker right away. Like for us, at least, is a deal breaker that if the founder is very cagey and say, "Hey, I won't tell you this," or "You invest and then I'll tell you this," it just like you don't know what to trust, right? So I think that this whole relationship starts with trust. As far as like VCs stealing it, first of all, I think there are very few VCs who would actually go and incubate companies. And most of them, like 99%, don't incubate company; they just invest, right? So it is possible that they look at your company, they don't like some part of it, or you can't get to a deal, and they see other founder, other company, and they can get to a deal. I don't see that as necessarily stealing. It's just there was interest, you couldn't get a deal, and they invest in another company. I would say that this whole thing about stealing is a bit overrated.
Yeah, no, I agree. It's a misnomer, and ideas a dime a dozen. It's the execution that really matters, and I think
Yeah.
everybody now is aware of that. And as a founder, it's funny because I think if you were seeing the kind of the AI thing, or you've seen a lot of trends that happen before time, you would have been able to position yourself to be very successful because you tee yourself up to once everybody knows about it, it's already too late. There's already like early adopters and people that have already done a lot of the heavy lifting and created a product. And because even now with AI, there's 1,000 companies that declare that they're AI. But if you have possibly done that or created an AI first company, I would say a year ago, and your odds of being at least raising funds or being more successful as an early mover advantage are better. So my question is, can you, without having a crystal ball, because nobody has that, how would you recognize upcoming trends that can be banked on, pun intended?
Yeah, I think that's one of the hardest part of the VC, right? So you mentioned about talking to founders. Why should you talk to the founders, right? So if you're just sitting at your office and like taking meetings, I think that is one thing that you'll miss on is the new trends, right? And that's why you actually go out there and talk to your founders. You expand your network, and there are multiple ways to do that. But I think it's very important to go out and do that. And the example of this is like in 2022 when OpenAI sort of came about. A lot of people did not know something like this was happening, right? People just thought that, oh, this AI didn't work last time. It probably won't work this time.
Yeah,
There's
it's going
nothing
to be
happening
another
there.
AI Pramod. It'd be because people were making look like it was people were making fun of it. Yeah, at some
Yeah.
point, you know.
Yeah. But the thing is, if you're in the right circles, right? I was just talking to someone yesterday that if you're in some of these venture firms and you're talking to the right people, you're friends with Sam Altman and like others, Elon Musk and others, right? So you know exactly what is going on. And that's one of those unfair advantage that you talked about is that access, right? So one is both access to the founders, also the other unfair advantage is access to information, like what's coming down the pipe, what is important. So there's a lot of VCs, a lot of people, they spend a lot of time like in Stanford and others because they want to be close to innovation. They want to see what these kids are doing. So that's how you stay close to new stuff.
And in terms of cybersecurity, to be specific, are there any areas within cybersecurity that you see are emerging? We saw Palo Alto stock went down due to various reasons, but it was, I guess, some folks said the whole idea of a one-stop shop, the platform is not successful. There were some other areas, but what's your take on where the industry is going from from an investment perspective and also from a technology perspective?
Yes, I think where the cybersecurity industry is today, like in 2024, it's pretty heavily invested. Like there are 2,000, 3,000 vendors in the space, and a lot of this large companies like Palo Alto, they themselves are building a lot of stuff. So I would say it's a bit saturated. Like there's very few sort of white spaces, and that's what like Palo Alto trying to replace other vendors. So they're giving their products away for free to have the customers try it out and replace the vendor that they have, right? But in terms of like sort of new investment and technology areas, like what I'm really interested in is this is very uh, like a hype thing right now is the application of AI in security. I still think that we are very early in that process. Just looking at log files, looking at people's behavior, I think we are still very early in that. That is something that I'm interested in. And the second thing that I'm interested in is the new threats that the AI brings to the table. For example, yesterday I was reading this article where so these hackers are basically creating sort of fake articles. They are mimicking some of these big journalists. So, for example, you search for something like stock price. So they actually give you a link to an article that looks like it was written by a major analyst, but it's a fake analyst. And then you click on it and it takes you to another website. And then it basically pushes you to make wrong decisions. So something like this.
So therefore, and that's also this scary piece with AI. You can poison, quote unquote, poison with enough data. You can poison the results of what the AI will generate, right? Because it takes existing information to create new information, right? So potentially you can poison it if the right amount of stuff to make it wrong. And then you mentioned also specifically that you like the AI component on the defense side, and I think I agree with you. I think that one of the issues with cybersecurity is that the signal to noise ratio has always been tremendous, meaning it's so hard to differentiate between good traffic and bad traffic, a good actor, bad actor. It's almost impossible. But potentially with AI and the ability to very quickly, dynamically build profiles, then you can help mitigate a lot of the threats. If you were a founder tomorrow, Pramod, and you had some funding, or you were bootstrapped, is there any ideas that you can throw out there? Because maybe somebody was listening to us and go out and build it, and in 6 months come to you and say, Pramod, you told me this was a good idea. I have it. Maybe you can invest. Any ideas that come to mind that you've seen?
I think there's a lot of co-pilot ideas. Like I keep saying this, like if you're a young founder right now and you're not looking for $1 billion exit, like you'd be happy to create something and get some business and get like a good exit. So there's a lot of co-pilot opportunities, like very simple, like even in cybersecurity, like I was mentioning, like application of AI in cybersecurity. So, you can pick anything like log analysis, you can pick like email analysis, you can pick behavioral analysis, you can pick like identity analysis, and then apply Gen AI, but apply like sort of Gen AI first. Don't think like what needs to be done, think like holistically, and then apply Gen AI and think very differently, like not the same way that we have been thinking traditionally, but what can I do with Gen AI? And I think you'll get a lot of good ideas and a lot of good businesses coming out of that.
In with the inception of no code, ability to create, do you still feel that you need to be a coder today, or can some of the no code application out there can generate a platform or a tool that is reliable enough or does the fact that you have a no-code application reduces the value of the company because they don't really necessarily have something proprietary that has been written by software engineers?
Yes and no. So I think the low code, no code is very important to do iterations, right? So if you are, like you mentioned, if you're a bootstrap, you don't want to spend a lot of money, I would definitely encourage to use this low code, no code, like just experiment quite a bit and see what's working. So as we talked about in the last podcast, like my thesis is always sort of build it first and then optimize it, right? So low code, no code is very good for that. Is just to try out multiple of these experiments. And then if something works, you can go and build it yourself.
And then at what stage would you know that you have an idea? Again, like if you're a founder, at what stage that you got something? Like, is it through feedback? Because sometimes you get feedback from family and friends and they tell you it's a great idea, but nobody wants to pay for it. At what point you get the feedback that you say, okay, this is great. This is going the right direction. I should continuously invest in this. We're on the right track. How would you know?
Yes, I tell. So there's a friend of mine who was starting a company, and I told him go get feedback, and he went and talked to all of his friends, and they all said it's a good idea. And then,
Case in
and then
point,
I asked,
Pramod.
yeah, no, it's literally happened. And then I asked him, are they going to pay for it? Are they going to use it? They say yes, no. Then I said, okay, at least you know that this is not a dumb idea because your friends did not like barf over it. All of them are saying it's a good idea, but it still not might be a great idea. It might be a good idea, not a great idea. So what do you mean? So I told him, look, now go and talk to 5 to 10 like cold customers. I even told him go to this conference and all of that, and share the same idea and see what kind of response you get. So he was really like pissed off and he didn't know why he need to do it. He's just like, my friends are like as smart as anybody else and they say it's a good idea, so it's a good idea. This company is ready to be funded. So I said, no, it's good, but can you just get me another 5 to 10? I even gave him names of people, but he didn't want to do it. And then something like this doesn't work long term.
And Pramod, you did a phenomenal job at answering all my shoot from the hip questions, which some of them were not easy. Let me just ask you like just one final question. That it's something you mentioned early in this conversation. You mentioned that one of the aspects that you do that requires some heavy lifting is once you make the investment, you are constantly assisting that company to make sure they're on the right path. How does that process work? Because I'm assuming once you have a set of portfolio companies, it's super tough for you. You're busy like doing all your things, and it's very tough to keep listening to what's happening and making sure that they're on the right track. Maybe you meet with them maybe once a month, once a quarter. It might not be enough to make sure that they're on the right track. How do you juggle that? What's the kind of your process, your individual process to make sure that you protect your investment on one side and also you want them to be successful?
But it's just very hard. I think like every day I get up, I keep like thinking that, hey, am I actually paying enough attention or am I paying like equal attention to all of my portfolio companies? What should I be doing for them? And a lot of these things that you need to start very early. Like I would say, I just don't have that much time in the day to do everything and get all of the dominoes falling in the right place.
Yeah, absolutely. And Pramod, that's why I'm even more appreciative of your time of doing the podcast today. And I hope that because a lot of it has to do with your personality. And I think when you get money funding from a VC, it has to be a match, not just from a finance perspective, but also from who they are and what they stand for and how to, with your, even the personality match. And I hope this podcast will allow people that are interested in investing to get to know you and maybe save some of that time because they don't have to, maybe they'll know you already prior to even meeting you in person. But I wanted to very much thank you for spending the time today. I feel like, again, I have a list of questions and maybe I have to be respectful for your time. Maybe you'll do another one to cover some more technical questions about valuation.
Yeah, sure. I think I would love to do that. I think I really like your style.
Yeah, thank you. Thank you. Yeah. I appreciate it. Thanks for the kind word. And we did cover quite a few topics that are, again, not easy. I think you spilled the beans. Maybe you'll have some of your VC friends call you up and say, Pramod, like, you can't do that. You can't open up the kimono for the entire world to see because they're going to use it to exploit us. But also, I think you provided very key aspects on what you should look for and how to make your time worthwhile. I think that key point about discipline is, I think there's one key takeaway for founders is to have that discipline to say no when somebody reaches out to you. But until then, what's the easiest way for people to reach out to you, Pramod?
It's LinkedIn is always the best. Yeah, LinkedIn is always the best. I'm always active on LinkedIn.
Fantastic. And for all those viewers, I highly recommend to follow Pramod, because he's got a knack of creating amusing but insightful posts. So I follow you closely, and I urge people to watch this to do that the same. And until then, thank you very much for all who joined, and looking forward to seeing the next episode. Thank you very much, Pramod.